The US Treasury just wrapped up a 10-year TIPS bond auction and it was awful with a huge tail indicating very weak demand. Here's what it means. So, for those who are not familiar with our Treasury bond auction videos, very briefly, Treasury bond auctions are conducted in a Dutch auction style. What this means is you have a starting price, otherwise known as a when issued. Here we're trying to sell 100 units of product XYZ. The starting price or the when issued is $100. Well, you have to go down in price until all 100 units get cleared. And in this case, in a weak auction, you have to sell at an ever increasing discount. The price has to go down, down, down. And remember, with a bond auction, what that means, the yield is going up as the price is going down. They are inverse to each other. So you have to sell at a lower price or a higher yield. Well, what the tail is indicative of is the difference between the when issued or the starting price and whatever you had to go down to get the auction to clear. Everyone gets awarded the same price down here. In this case, $60 is what the auction clears at. However, in a strong bond auction, what you see is the exact opposite. There's so much demand that people are willing to pay a premium above the price or the when issued. And that's what we see here. Well, the difference between the starting price and again, whatever it takes the auction to clear, the difference between those two is known as the stop through. It's the same concept of a tail, just in the opposite direction. You are selling at a higher price or a lower yield. Now, the other critical metric to know is the bid to cover. This is very simple. This is the total amount of bids divided by the total amount being offered. In this case, with the weak auction, you have a bid to cover only 1.0. Anything below 1.0, and that is what is known as a failed auction. Now, it's very difficult to actually see one of those due to primary dealers, for example. But here are the results for the 10-year TIPS auction. Now that we have that out of the way, high yield 1.734 versus a when issued of 1.684. What this means, a higher yield or a tail, a lower price, higher yield or a tail of 5 basis points. Now, 5 basis points is a lot for a bond auction. Bid to cover 2.2. This is roughly in line from my recollection of the past couple months of TIPS results. I don't have them in front of me, but this is roughly in line with what I remember the bid to cover to be. However, lower than during inflation of 2022. The bid to cover was much higher. Demand was stronger during the high inflation era. It was much closer to 2.5, 2.6. We only sold 19 billion. And of course, here is the share of who bought the 19 billion. We can see primary dealers, they bought 17.8%. Direct, these are hedge funds, for example, bidding directly for their own book, 26%, and indirect bidders, 56%. Indirect, this is proxy for foreign demand. Now, the key caveat here, this is the first video we've done on a TIPS bond auction because it was so notable with the tail, 5 basis points. This is the first video, so we have to make this explanation of how TIPS or how weak demand for TIPS actually indicates a slightly different thing. So remember, what a TIPS bond is, this is a Treasury inflation protected security. What this does, the goal of it is to protect investors from inflation. The principal value adjusts based on changes in the CPI index, and the interest payments are applied to that adjusted principal. What this means is that the yield here, 1.734, is actually a real yield above inflation. So what this means is if CPI comes in at 0, you will get 1.734%. That is what the yield on a TIPS auction actually indicates. This is above headline CPI. Now think about it. If inflation is raging like it was during 2022 and everyone is very, very worried about inflation, you would see very, very strong demand for a security that offers protection, offers premium above whatever inflation is going to be. You would see everyone buying TIPS because you don't know what inflation is going to be, but you do know that you will get a premium above whatever inflation ends up being. So you see strong demand during periods of time of high inflation, or if there's a concern of high inflation in the future, you see very, very strong demand. Well, remember, going back to this, strong demand is indicated by a stop through, not a tail. A tail indicates weak demand. Well, why would you see weak demand for a inflation protected security? You would see weak demand if you were more worried about growth. Because remember, in a hot economy, growth is up, inflation is up. In a cool economy, generally speaking, you might have disinflation or even deflation, and lower growth. So if you are more concerned about growth rather than inflation, you would see weak demand for tips. And that is what this is indicating. 5 basis point tail, very, very weak demand. Investors, at least in this particular auction, are not very worried about inflation. So here's where inflation is running. We can see everything, all four metrics. Headline CPI, core CPI, headline PCE, and core PCE are all closer to 3% than they are to 2%. In fact, core PCE and core CPI, which exclude food and energy, which are very volatile, are basically at 3%. By the way, we just got a Fed cut and indications of even further cuts with inflation at 3%. But that's a separate story for the video this morning. Now, expected inflation from UMich, the survey, consumers are expecting 4.5% inflation. So, of course, the average American is not participating in a treasury bond auction. But if there is significant concern, if this expected inflation was from institutional folks, if they were surveying institutions, you would not have seen a very, very weak 10-year tips auction. You would not have seen a tail. Again, because if everyone's very concerned about inflation, you would want to flock into a inflation protected security. However, if you're more worried about growth, then you would see weak demand, which is sure enough what we saw. Very weak demand, 5 basis points, certainly very significant. So here's a couple notable things that are worth mentioning when it comes to inflation. Here is the price of oil in red, and then what's called the 10-year break-even rate, inflation rate. This is actually derived from tips versus the 10-year treasury yield. And what we can see, the bond market is expecting 2.38% inflation over the next 10 years. And look, you can see the very strong correlation between oil price and this 10-year break-even inflation rate. However, over the past 12 months or so, we have seen this break-even inflation rate trend higher, despite the fact that oil is trending lower. Now, remember, oil goes into everything. The price of oil is critical for inflation. And so it is notable that you have a divergence here where break-evens are going higher despite the fact that oil is moving lower. Now, remember, oil is one of the energy is one of the few things keeping headline CPI, for example, below core. Because remember, headline includes food and energy, core excludes food and energy. So if you're getting disinflation or deflation from energy, then the headline number, the headline CPI, is going to be lower than the core, which again does not include energy. So one of the few things keeping headline CPI at 2.7 and not say 3 is energy. And we have a divergence here where inflation break-evens are trending higher despite the fact that energy is trending lower. Now, it should be noted, as I pointed out in the video this morning, the net long positions for WTI crude oil are at an all-time low, which what this means is more than likely we're going to see a pop in oil, and that'll take the commodity index also higher, which is heavily weighted toward oil. But generally speaking, really when it comes to growth, this might have been one of the things that scared investors, and again, more concerned about growth than they are about inflation. Even though inflation is running at basically 3% and we just got a Fed rate cut, it would seem that inflation concerns should be higher, but they're apparently not. Well, so they're more concerned with growth. Here's one of the prints that might have caused this over the past week or so. We got retail sales data. Now, in nominal terms, this looks quite strong. We can see that retail sales on a nominal basis, 5%. Now, as you can see, I'm putting my cursor over that. That is quite strong compared to the history of the chart going back to the early 2000s. However, once we adjust for inflation, we can see it's much more anemic. This is much lower once you adjust for inflation. Because remember, if prices are going up due to inflation, consumers are going to spend more dollars. The number of dollars being spent will increase. However, it's mainly just because prices are up because of inflation. So you have to adjust some of these things for inflation. And once you do, you see a much weaker story. Now, it did come in hotter than expected. This is just one of the prints that we've gotten. Obviously, there's been labor market softening that we have seen with initial claims, and of course with the non-farm payrolls. That might be adding to some of the growth concerns that we are seeing, which are indicative or indicated by the weak demand for tips. Now, just to finish up here, here is the Atlanta Fed GDP now, quarterly percent change. This is seasonally adjusted annual rate of return. Right now, we have GDP now running at 3.25%. So again, remember back in April, May, even June, you had all the kind of CNBC economists and fund managers talking about a recession and talking about growth falling off a cliff. Now, if you were following this channel, you would have gotten it right because we were calling for a reacceleration in growth, and that's exactly what we got. Nominal growth is now at 6%. And so that, one of those things, but the blue chip consensus here, you can see that the range of the top 10 and bottom 10 forecasts for real inflation adjusted growth is quite a bit lower than where the Atlanta Fed GDP now is actually coming in. Again, this is for quarter three. We know that quarter two came in at 3.3%, which was way hotter, way stronger than expected for quarter two. Well, quarter three is also coming in hotter than expected, and yet you still have those that are calling for an imminent recession, and of course, never answer the fact that in a recession, the deficit would probably go to 15% of GDP. That's a whole separate conversation. I will link that video at the end here in case you are wondering why the US cannot afford a recession. So, anyways, hopefully that was helpful. It was certainly notable that we got a 5 basis point tail with a treasury bond auction. 5 basis points is certainly notable. So, decided to do a video on it. Hopefully that was helpful. You can disagree with the market, which is clearly more worried about growth rather than inflation. I think that it's maybe a little bit backwards. So, anyways, hopefully that was helpful, and I will catch you in the next one.